Hey everyone, welcome to the weekly review. So last week we had a lot of economic data. We had the PPI come in significantly below expectation both on the core and regular PPI. Uh, Then we had CPI, inflation rate, which came in slightly below expectation. And we had retail sales, which came in significantly above expectations. And we had an update on the Fed GDP now from the Atlanta Fed. Which was revised a bit lower from 2.9 to 2, but still 2 is a good economic uh, increase in GDP. So this being said, data was good. I still believe we will see a tick up in inflation at some point, uh, and I would be skewed more towards sooner than later. I mean, not a huge increase, but a tick up. Uh, but this being said, the number of cuts priced in right now is way too high. We have basically 1% of cuts priced in until December and 1.5% until March, I think. Yeah, March. So this is way too many cuts. And this thread from Bob Elliott talking about the fact that even though inflation has dropped, we're not seeing continued acceleration down. We're more in a bottoming kind of stage. Basically, what I was saying last week about CPI potentially going higher soon. And various charts that show the same thing I was talking about. This is rental prices from CoreLogic ticking up, and so on. So this being said, there are way too many cuts priced in, and the way this works is the Fed either cuts all of it, meaning we might go to 2% rates, or it doesn't cut at all. And but at all, relatively speaking, at all. Maybe we get like 0.5% cuts and then wait, potentially get another hike later. So it's either recession or no recession. The Fed will only cut in recession, and if there is no recession and economic data is resilient, then we will basically have no cuts. Maybe we get 25 basis points as an initial cut, and then we just wait, just like the ECB did. We got a cut in May, I think, and now it's August, and no more cuts since then. So this is a scenario the market has not priced in, and it will have to be priced in. And this is theoretically bad for stocks. It has the potential to give us another leg down. But the other scenario is also bad for stocks because if economic data becomes more bearish, more pointing towards a recession, it will also make stocks goes down. But I think the first one, in which just the too many cuts are priced in, is the one the market would prefer between the two. Recession is worse. From the market's perspective, I think it wants too many things that are incompatible with each other. I think the market would prefer Trump wins. The market would wants no recession, but a lot of Fed cuts. And between these three, we can only have probably like one. Uh, like Trump is losing now. It's probably a coin flip before until the first debate, but for now, Trump is losing ground. And I think the only chance for Republicans to win is if we actually get a recession. Otherwise, they will kind of get slaughtered. Then the market wants a lot of Fed cuts. We're not getting a lot of Fed cuts unless we get a recession. So if the market wants Republicans to win, they want a recession, but they also want a lot of Fed cuts, which we're not getting unless we get a recession. But we also they want all of this without getting a recession, so it's incompatible. So it's not really a reality. And the question is, when will the market start pricing this in? Most likely slowly over the next couple of weeks. Probably J Powell will talk. He will have a speech at Jackson Hole probably Friday, I think, on the 23rd, and he will be speaking about a cut, but I doubt he will hint at a zero point 0.5 cut. We still have the August data to see in September before the FOMC and before OPEX. If that is also hot and no sign of deterioration, I think most likely we will be getting a symbolic 25 basis point cut in September, and all the other cuts will have to be priced out, and they will be priced out somewhere around this week here, probably around the next CPI print. Now that has the potential combined with the quarterly OPEX to give us that large pullback, like another 10%. But for now, going back into the micro detail, I think this still stands. But now I think the bias is bearish. I think it's more likely we get a breakdown, we retest the monthly quarterly open. If it holds, we go back up into month end, something like this, potentially even go up to here. If we miss this window of opportunity, because the window of opportunity for a pullback is now, but starting today should have happened on Friday, but it didn't. So I think it's missed right now. But let's say we have a delayed one in which we start another correction leg. If we miss this window of opportunity, the next correction leg is probably going to be around here. Somewhere around here it begins. And it will last until OPEX. So this is the window for correction. And we could potentially go higher, like 570, 580, more like 570 probably. Uh, this should not come necessarily here, but my target for upside is like 570, and this is looking more and more similar to what we had in 2021 at the end, in which all bets were that we were getting we're gonna go to 500, but we didn't. We stopped short, and the initial push up was 570, got rejected and started distribution here. Then we went to 470, 480, and that was it. After that, we started going down for a bigger correction. And I think it's plausible that we get something similar. There will be a lot of interest in 600, but we will probably not get to it. There is also this liquidator. Going to load up. Basically, based on this, if assuming liquidity stays flat, which I think it will, we have about 20 points of upside left from 1676 until, let's say, 1900. So 20x, 23 points of upside, which puts us just above 570, maybe something like this, 571, 72, after which we should correct again. But that correction can be more of a distributive correction, and then eventually when we get into the window of weakness, we start going down for real, and we should be hitting the lows around OPEX. So this is the plan now. I think today looks a bit bearish, but it's not the second leg down kind of bearish. It's more like we break the uptrend, but we start going up again, and potentially go up and stay near the highs until the end of the month. This will change obviously if we lose this level, but I don't think we will. And until then, just any pullback I think is a buying opportunity, as long as we stay above this level. Okay, that's kind of it for now. Have a good one. Bye bye.